Hey guys, what is going on? Welcome back to my Robinhood portfolio. I hope you guys had an awesome weekend. It's Sunday here, weekend's winding down. As you guys know, there's no trading on Saturday or Sunday, so not a lot to talk about with my portfolio. I did actually put out a video yesterday kind of going through my portfolio in a pretty detailed fashion. What I currently have in my portfolio, I broke it down by market sector, what stocks I have in each market sector, and how much equity I have in each stock. So if you're kind of curious about exactly what I'm doing with my portfolio, go ahead and take a look at that video. I kind of want to shift gears today and take a look at the federal funds rate or the federal interest rate. As you guys know, the Federal Reserve has been talking about raising the rate for a while now. To kind of put this in context, we're essentially in sort of a historic low interest rate cycle. The interest rate has been essentially zero or very low, 0.25%, 0.5% since late 2009, maybe even earlier than that actually, 2000, late 2008. So 6, 7 years of this particular interest rate cycle with no increases. So to kind of stave off inflation, the Federal Reserve is most likely going to be raising interest rate. They were going to be doing that before the election, but have kind of held off because of a lot of uncertainties with this election. But now that the election is over, a lot of the rhetoric coming from the Federal Reserve is essentially saying that they're going to be increasing that federal funds rate or that federal interest rate. And I kind of want to talk a little bit about how that's going to impact the stock market. So just very, very briefly here in a very simplistic fashion, I'll kind of explain, the federal interest rate, how it affects the market. So the federal interest rate is essentially how expensive it is for banks to borrow money from the Fed. And those banks use that money to lend to individuals as well as businesses. And if that rate increases, it's going to be more expensive for banks to do that, which will be passed on to individuals and businesses. So if you're an individual who buys a house, you'll get a mortgage from a bank, that mortgage will go up. And what's going to happen is that you're going to have less discretionary income for that individual, and they'll spend less on businesses, which will affect their profits. Sort of the same fashion, businesses who borrow from banks to expand their businesses, either building new buildings, hiring new staff, so on and so forth, will be less inclined to do that because it's going to be more expensive. So they're going to actually slow their growth. They're actually going to have decreasing profits, or so the theory goes. So both of those effects, discretionary income from individuals as well as businesses slowing down their growth, is going to affect their profits. And as you guys know, stocks are essentially how profitable a company is. So a stock, essentially a certificate for partial ownership of a company. If their expected future cash flows decrease, their expected profits decrease. Essentially, there's complicated formulas to do that, but essentially their future discounted cash flow divided by the number of shares gives kind of an idea of what their price will be. If that goes down, the stock for that company will go down. And really the whole market should go down, or at least that's what the theory says. So I kind of took a look at this, read a few articles. From what I can understand, there's been at least 5 tightening cycles within the federal interest rate cycle. Essentially, their cycles, they kind of increase by 0.25%, and they do that every few months. Since the 80s, there's been 5 of these: 1986, 88, 94, 99, and 2004. There's been some papers that have kind of looked at the total return of the S&P 500 before and after the Fed's initial rate hike. So going back, for example, to 1986, 3 months before that rate cycle started, S&P 500 was 5.6% returns. 6 months after, 27.4%, and 12 months after, 5.3%. So there really wasn't an impact on the market with that particular rate cycle. 99, for example, 7.1% before the interest rate hike. After that, S&P 500 total return was 7.7%, and 12 months after that, the S&P 500 total return was 7.2%. So really no effect on the market either. And the last one in 2004, before 1.7% total return of the S&P 500, 6 months after, 7.2% of the S&P 500 total return, and then 12 months after was 6.3% for total return of the S&P 500. So not a lot of impact on the market actually. So really, there shouldn't be, for long term, for a year, there might be some initial impacts, but for the overall return, there really shouldn't be a negative return on most major classes of assets. The only one the only one class of asset that really has a negative return is bonds. So bonds through these interest rate cycles may actually produce a negative total return, as you would expect. If you have a bond that's right now making 1% and the interest rate goes up, those bonds will be making 2, 3, 4%. Investors will go buy those and not be willing to pay the same price for bonds that are already currently in the market. So yeah, there could be a negative total return for those bonds. The other big takeaway from this is that there's going to be a lot more volatility in the market. So right now, the market has been, essentially pretty quiet, and there's been a little bit of volatility surrounding the election here, but there hasn't been a lot of, 5 or 6 point swings in the market. And with these interest rate hike cycles, there's going to be a lot more volatility. Like I said, the overall return may not be impacted dramatically, and there might be some, minor decreases in overall return, but there'll still be positive. But the volatility, there'll be wild swings, 4 or 5 point swings over months period of time. So those are the two things that we can probably expect with this next interest rate hike here. As you guys know, I'm a new investor. I haven't been through one of these tightening cycles before, so it's going to be interesting to kind of go through one of these. And these cycles typically last for a few years. So one in 2004, for example, extended through 2006. The one in 1994, for example, extended really until 1998 or so. And some can argue even to 2000. They really didn't increase the rate until 2001 or so. And the federal interest rate also on that last hike in 2004 didn't increase until the Great Recession of 2008. So it's going to be interesting. Haven't went through one of these cycles yet. Everybody's been talking about this is going to have a very dramatic negative impact on equities, but from what I've read, yeah, there might be some initial market volatility. Assets may decline, but over the long term, there shouldn't be there shouldn't really be any negative returns, except if you are in the bonds, if you're holding a lot of bonds. So that's just a quick and dirty analysis of what's going to be happening with the federal interest rate. Let me know what you guys think about this. Again, I'm a new investor. This is what I understand is going to be happening with this interest rate cycle here. After the initial rate hike in December, there's probably going to be another one a few months after that, and they'll continue doing this as long as the economy can support that. And it's all because they want the inflation rate to stay steady. So if the Fed doesn't do this, all this free money is going to increase the price of things, and inflation can get out of hand. That's from what I understand. So they're going to start this cycle here in December. I'm not sure how long it's going to last, but from what I read, there should be no long-term negative impact on equities, and there may be a lot more volatility in the market. So again, if you guys are experienced investors, if you guys have different insights, let me know. If you guys disagree, let me know. If you guys agree, let me know. Let me know what you guys are going to be doing with your portfolios. I'm probably going to be holding steady. I'm going to be dollar cost and value cost averaging the stocks I have. There's a few more stocks I'm going to be adding to my portfolio as well, but I don't think I'm going to do a lot of different things here. I'm not going to be holding a lot of cash. I'm not going to be necessarily switching asset classes. I'm going to be funding my Robinhood portfolio and, like I said, trying to pick, good large cap, blue chip, high dividend yielding companies. So let me know what you guys are doing with your portfolios. And with that, I'll kind of end the video here. As always, if you like my videos, feel free to like, share, and subscribe if you're so inclined. I'm a new investor trying to learn about the markets, and any input I can get is definitely appreciated. So if you have commented on my videos and given me some good insights, I thank you for that. And if you guys are also new and have some questions, feel free to ask, and we can kind of learn together. So with that, I'll kind of end the video here, and we'll see you guys tomorrow.